So talking about cost of capital from the word, interpret it yourself. Cost of capital. Cost of capital. Now, when we talk about cost, what do we refer to? Let's break down that word. Cost of capital. When we talk about cost, what are we referring to? Cost. Before we now move to the word capital. So what is cost? Yes. What is cost? That is how to understand the topic.
Okay, can I say something on that?
Yes, yes.
Okay, in my own knowledge, I would say is the amount incurred in carrying out an activity or purchase of goods and services.
Right. Very fine. Yes. What you incur, I saw a chart price. Yes.
So some expenses we incur in doing a particular thing.
Okay, yes. So in another way, if I want to speak like an economist now, I would say is a sacrifice made, right? To acquire goods or service. Yes. So what you are giving up to get something in return, that is cost. So now when we talk about capital, what do we refer to? This might sound so childish, but it's very important. Asking what is capital. Yeah. So what is capital?
So it's the money we set out to start a business.
Okay, the money.
Portion of money we are using to start a business.
Okay, very good. I think I like that. So now let's take it further. That portion
Hello,
of
sir.
money you are using to. All right.
Yes, is the fund is the money or fund invested in a project? The initial money invested in a project.
All right. Fine. Yes. So capital means the financial resources or assets invested in the business for the purpose of starting, operating, and expanding a business. So let's take it further. For you to start a business, for you to get this capital, there are various avenues you can source for capital. Now, can we mention these sources of capital that you know? What are these sources of capital? How do you source for funds?
Loans.
Borrowing.
So we have equity,
Savings.
Okay,
we have debt.
equity,
Issue
savings,
of
debt.
issue of
Fine.
shares.
Hello, sir.
All right. Yeah, I'm with you. All right. So I'm just doing this to make us have an understanding. Now, when you borrow money in form of loan, there is a cost attached to it. The interest you pay on that borrowing is a cost. Yes. When you invest your money in an organization in form of shares, equity, there is an expectation you have as a shareholder. And what is that expectation you have in return is dividend. So that money you're giving to the organization, there is a burden on them to use that resources to yield returns in order to pay you back. So your expectation in form of return is a cost, is a burden on the organization you are giving that fund to. Now, when you borrow money, the burden on you to pay back is interest. That interest is a cost of the loan you've acquired. It's the cost of the facility you've acquired. So, talking about cost of capital, I would say that cost of capital represents the compensation required by the suppliers of funds. The compensation required by the suppliers of funds from their investments. Those that have put in their resources to ensure that a business is set up, their expectation in return is a cost to the business. To the business is a cost. To you that you've given out your resources is a return. Is a return. So cost
Hello, sir.
of
We
capital.
cannot hear you. Oh.
I can hear you.
Hello, is anybody hearing me?
Yes, I can hear you.
If you have observation, just put it on the chat box. I will
I
see
can hear
it.
you.
Hello.
Ma, please, if you have observation, just put it on the chat box so that the recordings will not be noisy. Yes, so that when somebody else is listening to it, yeah, they will not feel irritated by too much noise. Yes, just put your message on the chat box. I will see it, and it is confirmed that every other person can hear me. Maybe you log out and log in again, then it will be fine. So, but once you have any complaint, just put it on the message on the chat box. So many people will listen to the recordings again. So once there is too much noise, even me, if I'm a student, I will not like that when there's too much noise in the class. So cost of capital represents the compensation required by the suppliers of funds from their investments. So it is the rate of return that the suppliers of capital, who are the suppliers of capital? Shareholders, owners, bondholders. So the return the shareholder is expecting is a cost to the business. So the business that is using the money, the cost, the burden on them is a cost. The burden of interest, the burden of making dividend, all these are expectation to the providers of capital, which is a return to them, So this cost of capital is the minimum rate of return a company must earn in order to retain its value. So anything below the cost of capital, once the organization computes internal rate of return, they will have a negative NPV. So what cost of capital does is that it acts as a benchmark for decision making. So before you can make a decision either to invest in a project or not to invest in a project, your decision can be premised based on the cost of capital that you've set for your organization. So anything above, below the benchmark will not be accepted. So a firm creates value when it provides a return greater than its cost of capital. So cost of capital is determined by the forces of market. Yes, by the forces of demand and supply. And these forces of demand and supply, they are the market forces. And what they do is that they represent the degree of perceived risk by investors. So it is how investors perceive risk in the market. If the investors are risk averse, if the investors are risk lovers, if their appetite towards risk is high, it can affect or determine the cost of capital. So the point is this. This can come out in a form of theoretical aspect. In the last exams, I was looking at the question paper this afternoon. Yes, I was seeing quite a number of theoretical issues. One thing with this exam is that you must balance your reading. As you solve, you must know why, the reason behind what you are solving, because it can come up in a theoretical way. Yes, it can come up in a theoretical way. So the question I want to ask now, even though I've given an hint about the question I want to ask is, why is cost of capital important? Why is cost of capital important? Yes. Why is cost of capital important in an organization? Why is cost of capital important in an organization? Can I get a response?
Hello, sir.
All right.
Okay, I think one of the, just like you mentioned earlier, one of the key importance of cost of capital is that it serves as a benchmark for decision making. So,
Yes. Yes. So when it comes to investment evaluation or appraisal, the primary objective of determining the cost of capital is to evaluate a project. Yes. That is the primary objective of determining cost of capital. So cost of capital is used to evaluate if a project is viable or not. So as we go ahead, we will discover that there are various methods used in investment decisions which require cost of capital. This cost of capital can be used as the cut-off rate or the benchmark, or it can be referred to as the break-even rate. So the cost of capital is used as the discounting rate of determining the present value of cash flows. That is, when you're talking about the discounted cash flow method, when you use the NPV, the internal rate of return, the APV, that is the adjusted present value, the modified internal rate of return, profitability index, and so on and so forth. So when you're using cost of capital for investment evaluation or appraisal, a project is accepted if it generates a positive NPV or its internal rate of return is higher than its cost of capital. So these are some of the things we'll be looking at. So talking about the importance of cost of capital, number one, it helps in investment evaluation. It helps in investment evaluation stroke appraisal. And more so, it helps to determine optimal means of capital debt versus equity. Now, what is the meaning of this statement? That cost of capital helps in determining optimal mix of capital. When we talk about mix, we're talking about the proportion of debt to equity to preference share. So let me ask a question. Among the various cost of capital, we have cost of equity, we have cost of debt, we have cost of preference shares. Take note, we have three forms of capital. It can be debt, it can be equity, it can be preference shares. So each of these forms of capital have a cost. So among these three forms of capital, there is a cheaper source of capital among the three, and the cheaper source of capital is debt. Why is it cheap? Because there is tax savings on debt. There is tax savings on debt. So if the cost of debt is cheap, don't you think investors will want to borrow money to run their business? So it will affect the optimal mix, the proportion of equity to debt, the proportion of equity, debt, and preference shares. So when the cost of capital is low, that cost of capital that is low will determine a high proportion of debt in an organization. So the cost of capital influences the proportion of debt and equity in the capital structure of a firm. So optimal capital structure of a firm can maximize the shareholders' wealth, because an optimal capital structure follows the objective of minimization of overall cost of capital of the firm. So the whole essence of financial management is all about maximization of shareholders' wealth. It's because we didn't start from the introduction, but that is the concept of FM, maximizing. How do we maximize shareholders' wealth? These are things we're still going to talk about. Yes. So talking about capital structure, talking about capital structure. When we talk about capital structure, there are three components of capital structure. That is elements of capital structure. Okay. There are three elements of capital structure. Take note. When we talk about capital structure, what are those things that make up the capital? Those things that makes up the capital. So let me write capital structure. Capital structure. Capital structure of a company should include one, we can have ordinary share capital. Ordinary share capital. And two, we can have what? Preference share capital. Preference share capital. Three, we can have what? Debt capital. So when you are given a question, most times you will see these three forms of capital playing out in the question. Sometimes you will see just ordinary share capital and debt capital. So each source of finance has a specific cost associated with it. So the cost of ordinary share capital is represented with KE, cost of equity. The cost of preference share can be represented as what? KP. The cost of debt can be represented as what? KD, cost of debt. Now, the average of all these costs of capital will give you what? The average of all these, of these three costs of capital, will give us what we call what? Weighted average costs of capital. Average cost of capital. That is the average of these three. And this is termed as WAC. It's termed as WAC in short form. Weighted average cost of capital. So we'll look at each of these elements of capital structure one after the other. So the first we're going to talk about is the cost of equity. Cost of equity. But before we forge ahead, who are equity holders? Yes. Who are equity holders? It's a very simple question. The answer is right on the screen. So who are equity holders? I just
The
want to
owner
ask
of the business,
the owner of the business.
the shareholders,
We know you have different types of shareholders.
the ordinary shareholders,
Ordinary shareholders.
Better, ordinary shareholders. So the cost of getting money from ordinary shareholders is cost of equity. Cost of equity. So this cost of equity is the minimum required rate of return expected by the equity holders or ordinary shareholders from their investments. So as you give out your money to Dangote, to Zenith Bank, that you're a shareholder with them, what you expect in return is what? A dividend. So to Dangote, to Zenith Bank, those things are costs of equity. Cost of equity. To you is an expected return. And that expected return is in form of what? Dividend. Dividend. So Cost of equity, it is the relationship between the amount of capital that can be raised and the expected return of shareholders from their investment. So a firm's cost of equity represents the compensation that the market demands in exchange for owning the asset. So sometimes, instead of using the word cost of equity, the examiner can say, what is the opportunity cost of capital? What is the opportunity cost of capital? So don't begin to wander around. What are they saying again? They are still referring to what? Cost of equity. Because that is why I asked, what is price, as at the beginning of this class? So, and I come up with my own definition, speaking from the economist palace, that's the sacrifice you made. So, you know, in economics, opportunity cost is what? The sacrifice you made, the foregone opportunity, the foregone price in place of another. So once you hear opportunity cost of capital, it can also be denoted as what? Cost of equity. So the point is this: there are two methods of calculating cost of equity. Let me be guided by my slide. There are two methods of computing cost of equity. Number one, in your notes, write these out now in your notes, because we are going to solve questions. So that when we start solving, I'll ask questions. You won't begin to say, go back to slide 7, go back to. So we have two methods of estimating cost of equity. One, we have the dividend valuation method. Dividend valuation method. You can write it in your own words in your notebook, so that when you see your writing, you'll be happy with yourself that, yes, this is what I've put down, and I think I can understand it very well. So, dividend valuation model is one of the methods of calculating cost of equity. So there are different scenarios under this dividend valuation model. We can have a case where dividend is growing, where dividend is not growing. Take note, when dividend is not growing, it means if you receive dividend of 4 kobo in 2025, in 2026, you still receive the dividend of what? 4 kobo. It means the dividend is what? Constant. But where dividend is growing, it means there will be variation. The dividend in 2025 will be different from that of 2026. If you receive 4 kobo as at 2025, in 2026, your expectation will be maybe 1 naira. That is an increase. That is a growing dividend. So, dividend valuation model. This model measures the relationship between dividend and the share price. Between what? Dividend and the share price. So cost of equity is the ratio of dividend to ex-div market price of equity. Ex-div market price of equity. Now, what do we mean by ex-div? Take note, anytime you are solving question on cost of equity, one of the points you have to look out for is the price and also the dividend. Has dividend been paid, or dividend is yet to be paid? If dividend have been paid, fine. If dividend have not been paid, it's not fine. There is something you need to do. There is a working you will need to do. So the point is this: when solving for cost of equity, the price must be excluding dividend. And that is why you can see XDiv. That is why you can see XDiv in brackets. This P here is what? Is the market price. You can see the definition. Market price excluding dividend. The D numerator is what? Is what? The current dividend. And KE is the cost of equity. So where you want to calculate cost of equity, where there is no growth in dividend, this is a case of constant dividend. You use this formula. Write it down in your book. You use this formula. That is cost of equity is equal to what? Current dividend divided by market price excluding dividend. Now, how will you know that the price in dividend? That is a question you must ask yourself. How will you know that the price is excluding dividend? Once the question puts it that dividend have been paid, it shows that the price is excluding what? Dividend. But when the question puts it that dividend is yet to be paid, dividend will be paid in 1 month time, it shows that this price here is including dividend. What will you now do to remove that dividend? It shows that you will do a working. The workings will now be what? Your workings will be what? Will be the price stated in the question. The price stated in the question minus what? The dividend quoted in the question. The dividend quoted in the question that is yet to be paid. So the price stated, dividend less dividend yet to be paid. Let me write it clearly. So once the question says that dividend is yet to be paid, it means the market price is including dividend. What will you do? The market price minus the dividend will give you market price excluding dividend. Hope you are getting it. Can I get reactions if you are getting it? If you know you are getting it. If you are not getting it, you can speak. If you are confused, you can speak. Now, these little workings is what we accumulate into a bigger question. Some of those that have done this course before, you discover that when you are solving some complex questions, some of these little variables will form part of your workings. So if you don't understand this, when you see big question, you begin to wander around and you say this thing is difficult. You understand? So you must understand this. So trying to compute cost of equity, where the dividend is constant, you use this formula. That is current dividend divided by what? Market price excluding dividend. So if this is fine, let's look at this. Let's look at this. All right, let me do something now. Let's do something. Okay. This is fine. Can somebody read this? Sorry, let me say, I think somebody is raising up his hand. Yes? Macaulay.
Good evening, sir.
Good evening, ma.
Please, sir, the formula, is it DO, the current dividend, is it DO or D?
It can be DO. It's still interpretation. It can be DO. Yes, all these are just expressions. Yes. D
Okay, thank
naught,
you.
D naught. Yes. So let's look at this question. Can somebody read?
Let me read, sir. Example, I love FMPLC has in issue has is it in issue 1 naira shares with a market value of 2 naira 40 kobo per share. A constant dividend of 30 kobo per share has just been paid. What is the shareholders' required return, KE in the bracket, and therefore the cost of equity to the company?
Yes. So I love FMPLC has an issue 1 naira shares with a market value. Market value of the share is what? That is the price of the share. 2 naira 40 kobo. The price of one share is 2 naira 40 kobo. Now, it's clear that the dividend is what? Constant, is not growing. Like a constant dividend of what? Of 30 kobo per share has just been paid. So you can see there is not any working because dividend has been paid. So the work is less. The question now is, what is the shareholders' required return? So based on the formula we've displayed, can you substitute? There is something I want to derive. Yes, can you substitute into this formula? Let's see. I want to get something. There is a mistake I'm expecting somebody to make. So can you substitute? What is your D? Your D in this question is what?
0.3.
0.3.
Okay, fine. And your price is what?
2.40.
2.40. Fine. So once you solve, what will be your answer?
12.5%.
So 12.5%. Who is not getting 12.5%? Who is not getting 12.5%? Let me see your hands up. All right. So, Esther, why are you not getting 12.5%?
Okay, so our
Yeah.
dividend is 0.3, while our market value is 2.04. So what about our XD? Which figure should we use to put to it? To substitute it. Do you understand me?
I'm very clear. I get your question.
Okay,
All right,
so
let's come back here again. I get the confusion. This price here, man, P. This price, it means that it must be excluding what? Dividend.
okay.
This value in word in brackets is just telling you that any price you are using here must be XD. You understand? That the
Okay.
price must be XD. Does not mean you are looking, there is no variable for it. You understand?
Oh, okay.
Yes.
Actually got 0.125.
All right, fine. That is
Okay.
it. So in percentage, it will be 12.5.
Okay.
So yes, Madam Macaulay.
So I don't have issue. I've gotten it.
Okay, your hand is, can you help me put down the hand so that
Hey, let me put it down. Sorry, sir. Thank you, sir.
right. All right, let's look at these again. Can we quickly look at these again? That a company is expected to pay a constant dividend of 40 kobo per share. A constant dividend of 40 kobo per share. The current SD market price is 3 naira per share. What is the cost of equity? What is the cost of equity? Just solve for what is cost of equity. Don't go to the next one because I've not talked about growth yet. I'm here to talk about growth. So what is
Yes.
the cost of equity?
13.3%.
Okay, 13.3%. So who is getting that? Who is also getting 13.3%?
13.3, sir.
All right, 13.3. 13.3. So this is where dividend is what? Constant. This is where dividend is what? Constant. So we can have a case where dividend will be what? Growing. We can have a case where dividend will be what? Growing. So where there is growth in dividend payments, the shareholders, all things being equal, should expect growth in dividend. If you're a shareholder in an organization and they are giving you same amount of dividend yearly, will you be happy? Even you as an individual, you need growth. Yes. So once you are getting same result every time, it shows that something is happening. So one thing that can cause that for an organization not to experience growth in dividend is you, as you make dividend in a year, you distribute everything without any retention. So for your business to grow, there must be retention. There must be plowback profit for expansion. So expansion will result into future growth. But as you make profit today, you distribute everything as dividend, you feel happy today. In the long run, you feel sad because there is nothing reserved for future growth. So, and when there is no growth, there will be no increase in dividend. So the shareholders will normally expect that there is growth in dividend payment over time. So the dividend growth model is simple and straightforward, but it does not apply to companies that don't pay dividends. So it assumes that dividends grow at a constant rate over time. Let's see, that's yes, with dividend growing at a constant annual growth rate. So where we have dividend that is growing, we use this formula. Write it out. We use this formula. So where a company is expected to pay dividend at a constant growth rate, in perpetuity, the cost of equity can be calculated as what? Cost of equity equal to what? Current dividend into the bracket of what? 1 plus G. That G is what? The growth rate. Divide by what? The market price. That's fraction plus G, which is also the growth rate. So where you have a constant dividend, please take note. You can have a question asking you to determine the market price. So let's assume that there is a question with a variable of cost of equity, with a variable of current dividend, with a variable of growth rate. But the question is now asking you, determine what? The market price. What will you do? What will you do? You know, this formula is for cost of equity, fine. But there can be a missing variable in that formula, and the question will ask you, solve for it. So I'm not asking where a question is asking you to solve for, to determine the market price, given every other variables. What will you do? This is a word problem now. What will you do? Yes? Madam Ngozi, you cross multiply?
Yes, sir.
Okay, so when you cross multiply, what will happen?
You know, since it is only the cost, the price that the market price that is not found, and the cost of equity is there and everything, so you cannot cross multiply. You use the market price as the subject of formula, and
All
you
right,
now
very
get
good.
this thing.
Very good. So everybody, write down that
Huh?
formula. Everybody, In your book, write down that formula as a simple exercise. Make PO a market price subject of the formula. Make PO subject of the formula. Let me see. If you know you cannot do it, just raise up your hand. Okay, oh, I can see one hand up. Okay, oh, it's now 2. Okay. I know most of you are using your phone. So I will not ask you to show me your screen and do it. We'll see how we can teach ourselves here. I know why I'm doing this is that I have a question I want you to solve, or several questions I want you to solve. They will not tell you to compute for cost of equity directly. Yes, they will tell you compute for the market price. Determine the market price. There's a way they will put the question. So it's not every time you expect that the question will say determine cost of equity, determine this. Yes, they can ask you to determine a variable in that equation. So what will you now do? It's just for you to make the unknown variable the subject of the formula. So let's see how we can make this the price subject of the formula in this case. Let's see how we can do that.
I'm still raising my hand though.
Okay, you're raising the hand for what, ma'am?
For the previous question, I thought you would have shown us how it was gotten, so that those of us that were not clear or did not get it will know where our mistake is from. So,
That is it the question we've solved?
yes, sir.
It's a straightforward, this is the solution, isn't it?
Yes, it is.
So
Okay.
I'm
Okay,
not
sir.
seeing
It's
it as
fine.
something ambiguous. That's why I'm it's not, this one is a child's play. Just for you to
Okay,
substitute
sir.
into the formula. The dividend is what? Constant dividend, 30 kobo. You put it in
Yes.
place of D. The market price is what? See it now. Market value, 2 naira 40 kobo. This is just
40
substitution.
kobo.
Yes.
Okay,
And,
sir. All
and you
right.
enjoy your life now.
Thank you.
Sorry about that anyway, that I didn't it's just so now you want to make P subject of the formula in this regard. What will you do? What will you do to make P subject of the formula? What are we going to do? So it can be in this form, KE. You know, we have equal sign. This G can cross to the other side, right? Isn't it? The G can cross to the other side. It becomes what? Minus G. Then you have it as what? Let me put this in brackets. Minus G. Then you have the equation to remain as what? Hope you can hear me, please. Somebody is trying to call me, and 1 plus G divide by what? Divide by P. Divide by PO. Hope you can hear me.
Yes, sir, we can hear you.
All right, fine. So now, in this regard, now you cross multiply. So when you cross multiply, what will happen? You have your PO into the bracket of what? KE minus what? Minus G equal to what? D into the bracket of what? 1 plus what? 1 plus G. So we're trying to make P subject of the formula, right? So what will you now do? You divide both sides by KEG, isn't it? Are we getting it? You want to make PO subject of the formula. What will you do? Divide both sides by what? KEG. So when you divide both sides by KEG, it will be in this form. It will be in this form. It's just, I'm just showing this. I'm not supposed to be showing this. It's just a simple mass. Minus G. Let me place it. Because of time, I can't go to the functions and pick them as appropriate. So let me do it this way. So when you divide both sides by KEG, you also have KEG here. So let me put the division sign to avoid confusion. So when you divide both sides by KEG, what will happen? This KEG cancel each other, right? Can I get a response? This KEG cancel each other, right?
Yes.
So you are now
Yes,
left
yes,
with what?
yes.
PO, right? Equal to what? Equal to this equation here. Let me write it. Equal to D into the bracket of what? 1 plus what? Plus G divide by what? KEG. So this is how the expression will look like. Who is not clear? Raise up your hand. You are not clear, raise up your hand. Don't feel shy, please. This is, yes, please, can you speak out where you are not clear?
Please, I was locked out, so I was not seeing what you were doing, sir.
That is serious. So at what point were you logged out, man? So what we are trying to do is that you can be given a question for you to determine price, the price. So when you're asked to determine price, you know, this is the equation, cost of equity equation. What you need to do is to make the price subject of the formula. And how do you make the price subject of the formula? Based on this function, KE is equal to DO into the bracket of 1 plus G divided by PO plus G. So we can move plus G. You know, this is plus G. This sign belongs to G. Plus G, when plus G cross to the other side of the equation, it will become what? Minus G. See it? So it will now be KE minus G equal to what? D into the bracket 1 plus G divided by the price. So to make P subject of the formula, you can cross multiply and say PO multiplied by KEG. You understand? So instead of saying PO times KE times G from our normal fractions in GS2, and you can just say PO multiplied by this bracket. See it here. It will be PO into the bracket of KE minus G, you close the bracket, equal to what? D plus 1, D multiplied by open bracket 1 plus G. Are you clear at this point, man?
Yes, sir.
So for you to make PO stand alone, what will you do? Divide both sides by KEG. When you divide both sides by KEG,
Hello?
sometimes PO is PO. So you are left with PO. You are left with what? PO. So the equation will now be what? PO equal to what? D into the bracket of 1 plus G divide by, the numerator is divided by KEG. So that is what we are saying in a nutshell. Hope that is fine, man.
Thank you, sir.
Welcome back. So now, okay, all right, fine. So in this question, we've solved for the A part. We've solved for the A part, right? And our answer regarding the A part is what? That a company is expected to pay a constant dividend. What is the cost of equity? What is the cost of equity if the current SD market price is 3? Fine. We've solved for that. So the B part now, what is the cost of equity if anticipated growth in dividend is 10% per annum? So what are we going to do in this regard? What are we going to do? What are we going to do? We are going to apply this formula here because the dividend is expected to grow at what rate? At the rate of what? 10%. 10%. So the growth rate is what? In another way, what is the growth rate in this question?
10%.
Fine, 10%. The growth rate is what? 10%. So when you substitute into this, in this question, your dividend is what? Your dividend is what?
40 kobo.
40 kobo.
40 kobo. Take notes. Sometimes we can always make mistake. When you're writing 40 kobo, you must make sure every other thing is in kobo. It will get to a point when you start solving on your own and you are seeing kobo and naira, you now begin to mismatch. When you mismatch kobo and naira, your result will not be okay. You can stay there for 30 minutes and be wondering what is happening. So when you are using kobo and naira, convert your kobo to naira form. Take note of this. So this 40 kobo, you know, it's written 40 kobo. If you want to write it to be in like times with naira form, how will you write it?
0.4.
Fine, 0.4. Because you can go and use just 40 kobo and you will not change your price to suit the kobo. So it must be in like times, 0.4. So your growth rate is what? 1 plus
10%.
10%, 0.1. Fine. So the price is what?
3
3
naira.
naira.
3 naira.
3 naira. Plus the growth rate again, which is what? 0.1.
0.1.
So simplify. At this point, you must know how to use your calculator. BODMAS is also very important. You don't just punch your calculator anyhow. You will not get the right answer. So it's one thing to have a very good calculator. It's another thing to know how to punch it and how to use the functions on those calculators. So when you simplify this, what will you get?
25%.
Okay, 25%.
24.6%.
Okay, 24.6%. Who is not getting that?
25%.
24.6%.
It's fine. 4.2%. Okay, fine. Madam Macaulay, your hand is always up. Is there any question?
It's a mistake, sir. I don't know. Sorry, sir.
No worry, I'll help
It's
people.
25%. I've gotten it.
Yeah, I'll help you put it down. Don't worry.
I'll put it down. I'll put it down.
So let's write down this question, everybody. Let's put down this question. Macaulay, the subject matter of this class.
Hey.
So now, let me say the ordinary shares of Macaulay are quoted at 7 naira 50 kobo per share. A dividend of 60 kobo actually this way, 60 kobo per share is about to be paid. Is about to be paid. Is about to be paid. Okay. There is so there is no growth. Yes. There is no growth in dividend. In dividend expected. Let me write it like in the UK American English. There is no growth in dividend expected. The question is this: calculate the cost of equity. Calculate the cost of equity using the dividend valuation model. Question is even very clear here. Using the dividend valuation model. State your answer as a percentage to one decimal place. At this point, everybody should know decimal place. To one decimal place. All this is testing your preliminary knowledge. Yes. So what is the answer to this? Somebody should have solved.
8.7%.
Wow, this is serious. 8.7%. Yes, anybody else with 8.7%? Anybody else with 8.7%? You are still pressing your calculator.
12%.
12%. Okay. Yes. Let's
12.5. 12.5.
Okay, this is
It's
interesting.
12.5%.
This is interesting.
12.5.
Okay, nice one. 12.5. Madam, how did you get 12.5? Tell me.
So this thing is 7 naira 50 kobo divided by 60 kobo.
Okay, did you read
And
the
I've
question?
got 12.5. But because it is said that the percentage should be to one decimal place, that is why I did not make it 12%. So I just make it, or be 13%, and now make it 12.5.
Okay, that is fine. I think your network has been pulling you out over time, and that is why there's a mix-up somewhere. We stated that. Okay, don't let me even talk. The first man that gave us the answer. Can you just explain?
Okay.
Well, actually,
Okay.
my name is Mr. Michael. Actually, I joined I joined this lecture very late. Okay, but I just on my own. I just tried to.
All right. Your network is
What I got it. How I was able to get that.
okay. We
12
get
point.
your network is having some issues. So yes, somebody else wanted to say something before.
My name is Friday.
Yes.
From this question, you can see that in this question that the
So
dividend
can you
is
hear me, sir?
the dividend is give, and which means that dividend has not been paid yet. So we have to deduct the dividend from the price of from the market share.
All right, fine.
So when you get 0.9, so when you divide the dividend by the price of the X price, XD price, so you arrive at that 8.7%. That is
All right.
0.60 divided by 0.9.
All right. So that is it. So for everybody getting 12 points something, this is it. The point in the question is that a dividend of 60 kobo per share is about to be paid. It means in 7.5%, this 7.5% is cum div. There is dividend in it. So you need to make it ex div. How do you make it ex div? You deduct the dividend value from this market price to make it what? Ex div. To make it ex div. So you don't just, when the other ones you've solved, it was stated ex div. So I made it clear that once you see cum div, you must always solve, convert back to what? Ex div, to ex div. So the quoted market price is including dividend, which is cum div. So we need to remove the value of dividend from the quoted market price and make it what? Ex div. So your ex div market price will be what? Ex div market price will be what?
6.9.
Minus 0.60. You have it at what?
6.9.
6.6. So in this regard now, you cannot make use of your formula. You cannot substitute directly, isn't it?
Yes.
So when you substitute, what will you have?
8.7.
8.7, right? So
Yes, sir.
8.7%. So that is what you're supposed to get, not 12, because there is elements of what? Of dividend in this quoted price. So you need to make it XD. You need to make it.
That thing is 6.9. It is not 0.9.
Mm-hmm. That's much.
Please, how do we get that 0.9, please?
It's 6.9.
Okay. Sorry. So when you solve, you have what?
8.7%.
8.7. All right. So this is it. So there is this other question. Let's see. Let's see. Let's take down this question again. In this class. All right.
Sorry, please. I want to find out, is the 8.7, is it in percentage or just 8.7, please?
It's in percentage, sir.
Okay, then.
So Badmos Badmos has just paid. Badmos has just paid a dividend. A dividend of what? Of 10 kobo. 10 kobo per share. Dividend of 10 kobo per share. Badmos cost of equity. Badmos cost of equity. Badmos cost of equity is what? It's 15%. 15%. And dividend are expected to grow by 3% per annum. Question is this: what is the ex-div share price of Badmos? So can help us out. What is the ex-div share price of Badmos? Any attempts? The reason why I explained subject of the formula is just because of a question like this. So use that subject of the formula concept, because they are not asking you cost of equity. They're giving you, right? Is in the question. So they are not asking you what is the ex-div share price of Badmos. So that denominator in that formula is what they want you to derive. So you should be able to do that very fast without any much delay. Yes, anybody to give us the answer? Yes. Still waiting. Nobody is helping us out. So this is the formula you're expected to use, because you are expected to compute for what? The SD share price of Badmore. So this is the share price being made as subject of the formula, which I've explained before now at this point. 0 points.
0.85.
0.86.
Okay. So approximation.
Is equal to 0.85.
So from the question, dividend is what?
Manijarafa.
0.1.
From the question, your dividend is
0.1.
dividend is 0.
Because like
Then the growth rate is what?
so from here you when you compare
0.03.
The growth rate
0.03.
is, yes, 3% is 0.03.
Yes.
And the cost of equity is what?
0.15.
15%.
15% of 0.15. And the growth rate is what?
0.03.
0.03.
So once you simplify, your result will be what? Once you simplify, your result will be what? Your result should be
85.
yes, approximately 0.86.
Yes.
86 what? What will be this, the units of measurement here? Is it percentage? Is it, I want to just get something. The unit of measurement of this is what?
Kobo.
Naira. Kobo.
Fine,
Naira.
fine. This is 0.86 kobo. Because what is the SD share price? It is kobo. Do you understand? 0.86 kobo. 0.86 kobo. So you must be able to know what you are computing for. You are computing for share price, and price is in what? Is in naira. So take note of that. Take note of that. Let's take it further. So there are various ways you can determine growth rates. Take note. There are various ways you can determine growth rates. Growth rates, that is estimation of growth rates. Growth rates can be computed using historical pattern or Gordon's growth model. Gordon's growth model. Now, when you're trying to use the historical pattern, this historical pattern is also known as averaging method. Yes, or the average method. So this method assumes that the past pattern of dividend is a fair indicator of the future. So growth rate can be computed by using the formula seen on the screen, where you have the DO or D naught represented as current dividend, and you have DN, which is the past dividend, everything to the power of 1 over n. And what is n? N is the number of years you've experienced growth. The number of years you've experienced growth. everything minus 1. So in a question, you can be asked to determine the growth rate. They won't give you the growth rate. You've been seeing questions where they tell you growth rate is 10%, growth rate is this percent. Some questions will not give you that. They want you to determine growth rate yourself to be used in solving a question. So you can use this formula at seen. Now, this formula can be expressed in another way. If you are very good at indices, SS1, indices, you know that this 1 to the power of n can be represented as a square root, as a root, in root sign, instead of having the power up here. When you remove this power, you can represent it as a root. I think I have it here. Let's see it. Okay, it's not okay. So let's see. Yes, you can represent it as a root. Yes, though this I was not able to get the right sign for root that will cover everything. So it can be represented as a root sign in this form, where you have it as n minus 1, everything here to the root of what? DO divided by DN. Take note, the root cut across this numerator too. It cut across the denominator rather. It covers DN minus 1. I was not able to get the right expression for that, so that is why maybe I was not patient enough to use my tools very well. So to estimate growth rates, we have two methods. The historic approach. In using the historic approach, you can have dividend for 2020, dividend for 2021, dividend for 2022, dividend for 2023, dividend for 2024, dividend for 2025. You can see based on the question is already giving you historic data, past data. So once you're giving past data, what will you do to determine your growth rate? It is to use the information given and representing that information or those information in the formula seen on the screen. Now, DO is what? Current dividend. Now, if the last, for example, using this question as an example, the current dividend in this question will be what? Year what? The current dividend in this question will be what? Year 5.
Year 5.
Year 5 is the latest. You understand? So now, it means when you're trying to apply that into this formula, the current dividend DO will be the current value of dividend, while DN will be what? Dividend in the past. That is the base dividend. That is the first. This value here is the base dividend. The base dividend, the year in which the dividend commenced, is the base dividend. So the dividend in the past, that is the base dividend, and to the power of 1 is constant, divided by what? N. What is N? Number of years we have experienced growth. Number of years we experience growth, or number of years of dividend payments. Now, there is usually a confusion sometimes. Sometimes we usually experience some form of confusion when trying to solve questions where we are giving years in terms of dividend. We are giving years in terms of dividend. Sometimes we experience some form of confusion. Because the base year sometimes is the starting year. So sometimes you begin to count from the base year. For example, in this question now, if we are asked the number of times dividend is paid is how many times? From that question, what is the number of times dividend was paid?
5.
5 times.
5 times.
5 times.
Okay. That is great. Yes, dividend was paid 5 times, right? Any contrary opinion?
No, sir.
Okay.
Yes, sir.
Fine.
Yes, sir.
Somebody say yes, sir.
Yes, sir. Sir, can I ask question?
Yes, you
This
can.
is pattern. Is it the same thing as extrapolation dividend growth rate?
That is
Because
extrapolation.
that one to ask latest dividend over base dividend. I don't know whether it's the same, is another name for it, another way for it, or I don't know, or is another thing entirely.
It's the same thing, man.
Okay, sir.
It's the same thing, man.
That's it.
So in this, when you are giving historical data in this form, take note, the number of years given will be less, you will less one from it. How it is being computed is that from year 1 to year 2, from year 1 to year 2 is 1. From year 2 to year 3 is what? Is 2.
It's 2.
From year 3 to year 4 is what?
It's 3.
From year 4 to year 5 is what?
Oh.
Is 4. Is 4. Is 4. So it means that the starting period, the end of this, you begin to count from the end of year 1. Yes, from the end of year 1. From the end of year 1 to the end of year 2 is 1. The end of year 2 to the end of year 3 is 2 rather. And end of year 3 to end of year 4 is 3. End of year 4 to end of year 5 is what? Is 4. Is 4. So in this formula, let me go back there. You can see in this formula here, you can see n minus 1. N minus what? Minus 1. That is when you are using this approach. Please take note, when you are using the square root approach, the formula is n minus 1 to the square root of. So the number of years given in the question will be what? For example, in this, it is 5. So 5 minus 1 will give you what? 4. Will give you 4. So you use 4. The 4th root of the items in the root is what you have to determine. Then minus 1. Let's look at an example. Let's look at, let's pick an example. Let's look at an example in relation to this.
Hello, sir.
Yes, ma'am.
Sir, I would suggest that we use the 2 formula.
Definitely, we'll use the 2 formula, ma'am.
Okay, thank you, sir.
So now let's just pick simple example first. Now, looking at this question, that a company currently pays dividend. A company currently pays dividend of 32 kobo. 5 years ago, the dividend was what? The dividend was what? 20 kobo. Estimate the growth rate. Estimate the growth rate. So now, in solving this question now, using this formula, this historic approach, historic formula, using this approach here, your current dividend is what? Your DO is what?
0.3.
0.32.
Yes, that is a company currently pays 0.32. And 5 years ago, that is DN now. DN is the past dividend. DN is what?
The past
Zero.
dividend.
0.5.
Okay.
So,
0.2.
0.02.
yes, 0 point. And it is stated that what? 5 years ago, right?
Mm.
5 years ago. So when you substitute 1 all over n is what? The number of years.
More years.
Minus 1. When you do that, you're going to determine your growth rate. Your growth rate. So, though it's up on the screen, but please write it out and compute your calculator to confirm if what is on the screen is correct. Write it out and substitute the various values. At this point now, you need a calculator. Let me check for my own calculator, my own scientific, because I'm having a market human calculator here. Zero 0.32 divided by 0.20, 0.6. Okay. Six. Mhm. 6.
1.6.
So what do you have? Yes, what do you have, please?
1 point.
You should have 9.8. I've punched my calculator. Okay, let me do it the way. Let me see.
9.9.
1.6 to the power of. I know some people at this point now begin to find it difficult to punch their calculator. The power of minus 5 multiplied by 100. So what do you have?
9.9.
9.9.
9.8. 9.9.
Explain. How did you punch your calculator? Somebody is waiting.
I started with 1 divided by 5. I got 0.2. Before I now did 0.32 over 0.20 raised to power 0.2 minus 1.
Then you were able to get what?
I was able to get minus 1, 0.9 something. Then I multiplied by 100. That's when I got
Okay, fine.
9.8.
So now let's use this. Okay, who is not clear with that, please? Before we move ahead, who is not clear with that? You are still battling with your calculator. Speak out.
Yes, looking at mine, I divided 0.32 by 0.2. I got 1.6. And then 1 divided by 5, I got 0.2. But I want to find out this, I say one that is there, I say it's 1 minus g. So what would I have to add there to be able to get that figure that's supposed to, minus one will minus from to get the right answer there? I can't really see it clearly from here.
Okay. So when you raise can you see it now?
Yes, I can.
So your results, when you say 1.6 to the power of 0.2, what do you have?
Okay. What I've got 1.6 to the power of I got 1.0985.
Minus 1.
Sorry?
That's 1.09 minus 1.
Okay, minus 1. Okay, it gave me 0.098.
And you
Right?
multiply that by 100.
Times 1.
So now,
okay.
let's now use this formula here. You know, in this question, they didn't give us the historic pattern. They didn't give us year by year. They just say 5 years ago. So now, use this formula now. This one with roots. But please take note, I've stated clearly that the root is covering DO and DN. Ignore this division sign, please.
Okay.
Don't go and solve and use division sign. Ignore it, please. It's supposed to cross down. You understand? So ignore the, okay, so sorry, the division sign is there, but the root covers both DO and DN. Yes, please take note of that. The root stretched downward covers DO and DN. So now when you substitute now, in this case now, let's see if we'll get same results. 0.32 divided by 0.20. You have 1.6, right?
Yeah.
So the fifth root of 1.6 will give you what? 5. Second function, this 1.6. I have 1.098 minus 1. I have 0.098 multiplied by 100. I have 9.8. Is it not same result?
How did you get your second function? No, borrow to Daru.
No, it depends on your calculator. You know, we have different calculator. If you check your calculator, in my own now, I have shift. There are shifts at the upper hand of the upper side of the left-hand side of my calculator. Shift.
Sir, please, I'm
There is
getting
a
into
yellow
your,
inscription.
sir. Excuse me, sir.
Yes.
So you wrote
I can hear
5,
you.
now this shift, then we did x square, right? We input a 1.6. So what did you do next?
No, in my own calculator, I have an inscription that is telling me that the root, there is a root with X. Check your calculator, a root.
Yeah, I've seen that.
Yeah, fine. So you press, I put 5, second function, that root with X, 1.6. I type, I have 1.098 minus 1. I have 0.098. Have you been able to determine that?
Please come again.
So I've gotten 1.098.
Very good, minus 1.
Okay, minus 1 times 100, right?
Yes.
Thank you, sir.
So I didn't get it though.
Okay, so now I got 9.85. Okay, 9.8.
You know, in this class, you teach how to press calculator too. No, it's not peculiar. When you are doing even SFM class, we teach them how to press calculator. So it's not peculiar to, I don't know if I can show my screen. If
Yes,
I
sir.
should, you want me
Yes,
to
sir.
show myself? I don't know how that will work anyway. Let me
Yes, sir.
see.
The first formula we use, sir.
Yes, sir.
The first formula we use,
Yeah.
the number of years was 5. We minus 1 to make it 4, isn't it?
No.
Or numbers of years. The first formula we use.
This is it, sir. This is it. You know, in this question, the dividend growth is not giving you, they are not giving you year by year. So where you are to minus 1, where you have to say n minus 1 is when you are giving it in this form. You understand?
Okay.
When you are giving the dividend year by year. You understand? But in this case, the question just simply puts
Okay.
that's, where is it? That 5 years ago, right? Yes. So hope that is fine, please. Oh, you are still battling with the calculator.
I made a video and I sent it to the group. I don't know if that is okay.
Okay, fine. Thank you. Yes, thank
Mm.
you. So now let's look at this example again. Let's look at this. That's the dividend of Temi PLC the dividend of Temi PLC over the last 5 years are given below. Year 1, 180, 2, 210, 3, 220, year 4, 245, year 5, 280. Temi's PLC current ex-div market price is 4 naira. It has an issue 1 million ordinary shares. So the point is, in this question, we need to determine the cost of equity. The cost of equity. The cost of equity. So for us to determine the cost of equity, we need to determine the growth rate first. We need to determine our growth rate. So my point of concern about this question is on the issue of growth rate. We're going to use the two formula approach likewise to determine if we're going to get same growth rate value. Now, using this formula here, your current dividend is what? Using this formula here, your DO is what? 280.
280.
Fine. Now, your DN is what? The dividend in the past, that is the base dividend, the first one is what?
180.
Okay. 180. Fine. So now, using this formula, your N will be what?
5.
Oh, 5 minus 1, so 4 is
It will be 4. So when you simplify that, your result will be what?
1.556.
1.556 minus 1.
Yes, sir.
That is 280 divided by 180.
Okay. Thank God.
To the power of 1 divided by 4, 0.25. Yes, what is the result? 0.25 minus 1
0.12.
times
11.7. 11.7.
yes, 11.67896. Then you approximate 11.7. Yes, Titi.
I can't see the screen.
Okay, use your network.
No, sir, the
Can
rest
you
are coming more.
go log out and log in again? Hope you can see very well. You can mute yourself. The noise somewhere. 280.
Titi Lion, mute yourself.
So once you solve this, your result should be what? 11.7%. When you use the other approach, the other formula that has square, there you say n minus 1
equals to okay.
I'm looking for the appropriate n minus 1. You say 280 divided by 180 minus 1. Your n is what? 5. So 5 minus 1, then everything roots. So can you solve and give me the results? Let's see.
Okay.
11.76.
So is it same results?
Yes.
Oh. But the question wants us to determine the cost of equity. Cost of equity. That let me go back to the question again. That the dividend of Temi PLC over the last 5 years are given below. Temi PLC current SDIV market price is 4 naira. SDIV market price is 4 naira. It has an issue 1 million ordinary share. So, though I think the question is not, I didn't put it complete. So, what the point is, calculate
Hello, Mr. Said.
the cost.
Okay.
Calculate the cost of equity. So, using the information, how are we going to compute the cost of equity? How are we going to compute the cost of equity? Which formula are we going to use? Which formula are we going to use? This formula, right?
15%.
Yes, sir. Yes, sir.
We're going to use this formula. So my concern now, the concern now is the current dividend is what? On the question. 280. Current dividend is what? 280,000. Now, what is your growth rate?
11.7.
11.7.
Approximately, let's make it 12%.
12%.
Then what is your market price? The market price is what?
4 million.
Naira.
1 naira.
The market price is 4 naira.
4 naira is for how many shares?
For one shares.
1 million.
4 naira is for one share. So you can see these values we are using here. We are using in total, not in units, isn't it?
Yes, sir.
It
So
is.
now, for you to get the value of 1 million shares, what will you do?
4 naira multiplied by 1 million.
Yes, 4 naira multiplied by, you can do it per unit. If we are doing it per unit, you divide 280 by 1 million shares. You understand? You still get same results. If you want to do it based on 1 unit, but since we are doing it based on total, it will be, instead of writing 4 here, it will be 4 times the number of overall number of shares, which is 1 million. So we have 4 million. Let me write it. 4 times 1 million. So when you do this plus the growth rate is what? So when you simplify, what will be your results? Yes, once you simplify, what will be your results?
%19.8%.
19.8%. Any other person with same
Same
result?
answer.
19 points. 19.8%. Who is not clear, please? Who is not clear? Assignments.
So I'm raising my hand. You didn't see my hand.
I didn't see it too. I'm only seeing Titi Lyle's hand, but I think he's in error. So Titi is my younger sister, so I can decide to ignore her question. So, so Titi, what is your question?
From the mistake.
It's fine. So, who is raising his or her hands again? I can't see your hand, ma. You said you're raising your hand.
I raised my hand. Yeah.
Okay, ma. Okay. So, what is the question?
Sorry, I got lost when you said it was in units. You said 280,000 divided by 1 million. Can you, I don't know, can you go back to that? I didn't get what you said.
This is it. These values of dividend, they are overall value. They are not dividend of one share. The dividend of one share in year one will be what? 180 divided by 1 million. The overall number of shares is what? 1 million ordinary shares. So if you want to know the earning per share, will be 180,000 in year one divided by the total number of shares will give you the dividend for one share. You get that? So now, since we are not, the dividend for one share here would be what? 0.18. Do you understand? The dividend for one share here, that is 280 divided by 1 million shares will be 0.28, 28 kobo.
Okay.
Now, the value, the SDIV market price of one share is what? Is 4 naira. Do you understand? So when you go with this approach, what will be your result? 0.8 divided by 0.28. Sorry. That is 0.28 divided by what? Divided by 4. So the bracket of 1 plus what? 0.12 Then when you divide, okay, when you divide by 4, you have what? Divide by 4 plus 0.12. What will be your results when you simplify this? I want to know. Simplify this, let me see.
I'm sure, no, I'm not with calculator, yeah, but I get it now, sir.
All right. So somebody should help me out. Let me know what will be the results.
Result will be
1.12.
the result will be 0.1984.
So it's still correct. So,
yeah.
But let me reiterate. Let me reiterate what I'm saying. Yes, it can be very confusing sometimes. Let me reiterate. The point is, what we've done at first is that we use the total value of dividend. Yes, total. But in this case now, we are now using the dividend on one share. On one share. So that is why the solution is like this in this case. So when you check the other one, that is this particular one, you can see we are using the overall total, and that is why we have it in this regard. Any further question?
Thank you, sir.
So let's take down assignments. One of the beauty of my own class is I like disturbing students with assignments. Yes, because if you don't solve, if you don't practice, you will not have strength in the hall, and you'll not be exposed to issues. So this question that you are seeing on the screen, is it suitable as an assignment? Let me see it. What is the growth rate of TPLC? What is the growth rate of TPLC? And more so, we should add something else. Growth rate of TPLC and the costs of equity capital. The cost of equity capital. Cost of equity capital. So this is not an example, it's an assignment. You can screenshot it once. But I'll forward the slide.
Sorry, what's the last question, please?
That's what is the growth rate of TPLC and
yes,
the cost of equity capital. And the cost of equity capital.
Okay, thank you.
Let's take, I'll send the slide in case you are writing, or you can just take a screenshot anyway, because I have another thing to attend to immediately after this. I might not work on the slide immediately. Let's take this question again. Let's take this question as an assignment.
Please, I'll show the slide so that we can screenshot it now.
Let's take.
I'm posting on the WhatsApp group already.
All right, thank you very much. Oh, I love this concept. No time to waste. So, assignments. Assignments. Okay. Bisola PLC. Bisola PLC is financed entirely by equity. Now, when a business is financed with equity and debt, it means the business is what is geared. Take note of that. But when a business is solely financed with equity, it is what?
It's
Ungeared.
not geared.
Yes. So Bisola PLC is financed entirely by equity. This is an ungeared company. The company has 150,000 ordinary shares. Ordinary shares of 1 naira, each, currently quoted at, let's say, 3 naira 42 kobo. Currently quoted at 3 naira 42 kobo. Ex-div. All what we've been discussing since morning is still on cost of equity. What's in the next class, we'll talk about cost of debt. We'll move on in that order. So the company's current dividend of 6,158 was paid recently. Out of the company's earnings of, let's say, 62,858. The capital employed. Don't go and use ChatGPT for my assignments. I gave performance management assignments, so people were using ChatGPT. It's not ChatGPT that will write the exam for you. So once you use ChatGPT, I will know. Yes, because it's a tool I'm also familiar with and I use also. So as you are studying it, I am using ChatGPT. You are not helping yourself. So it's better you tell me you don't even know it. Let me explain. Don't be a ChatGPT student accountant. It's not, does not make sense. The capital employed of the company is, don't when you use ChatGPT, in order not to embarrass you, I will just do as if I will just say good. So it's better you go and do it manually. Where you are cooked, you ask for help and you use ChatGPT and forward assignment to me. I don't need you to impress me at all. You go and impress the examiner in the hall. That is what I want. Collect price. 2473 was paid was paid 5 years ago by the company. Required what is the company's cost of equity capital? What is the company's cost of equity capital? So take note of this. Well, before we round up this class, there is something I will need to talk about just briefly. The other way you can compute growth is using the Gordon's growth model. Let me go back there, because in the next class I'll not like to talk about that. Using the Gordon's growth model. That one is also a very simple approach. A very simple approach using the Gordon's growth model. Let's see that. Yes, fine. Gordon's growth model. So this model can also be used to determine growth rates. Growth rates. So in Gordon's growth model, growth is measured as what? G equal to RB. And what is R? The R is what? The accounting rate of return, or return on reinvested fund. How do you determine that? You can have your earnings divided by book value of equity, capital employed, multiplied by 100%. And your B is what? The earnings retention rate, or proportion of funds or profit retained. And B, in some instance, can be computed as 1 minus dividend payout. 1 minus dividend payout. That is what you retain. What you retain. After paying out your dividend, what is left is retention. So another way you can compute growth rate is using the Gordon's growth model. The Gordon's growth model, where you determine your accounting rate of return, or return on reinvested fund, multiply by what? The earnings retention rate, or proportion of funds or profits retained. Let's see, I think I have a simple example here. Yes. So we have this example regarding that NAWA PLC retains 40% of earnings each year and is able to reinvest so as to earn a return of 20% per annum. What is the expected growth rate in dividend? So in simple term, your retention rate is what? Your retention rate is what? From the question. Retains 40% of earnings each year. Yes.
40%.
Your retention rate is what? Your earnings
It's
retention rate. Your earnings retention rate is what? That is your
40%.
40%.
40%.
Now, what is your R? The accounting rate of return. Your R is what?
20%.
Yes, a return of what? 20%. To earn a return of 20%. Yes. So you see, it's just for you to multiply, and you have your growth rates. Your growth rates. So you watch out for questions as they come. The question can want you to use the Gordon's growth model. I want you to use the historical approach. So you watch out for that. So this Gordon's growth model assumes that the higher the level of retention in the business, the higher the potential growth rate, which I've earlier explained, that the more you keep fund, you plug back profit, the more expansion you experience, and the more growth you experience, the more growth you experience in the future. So there is something else I can also show you as it relates to B sometimes, because in this course, if you go to different books, you see different formulas, but they are leading you to the same approach. Your B can also be earning per share. Let me quickly state that earning per share minus dividend per share, everything divided by what? Divided by earning per share. This is the same thing as 1 minus dividend payout ratio. You understand? This is the same thing as, so it depends on the variables given to you in the question. You understand? So where the question is giving you earning per share, dividend per share, you can quickly get the value of what? Of your B. Of your B. So it's either you use this or you use this. You get your retention rate. You get your retention rate. So please take note of that. This is very important. Very important. So, though we've dwelled too much on cost of equity, I don't want to rush this topic. Yes, I want to move very slowly, and that is why I'm moving this way. Yes. So we are expected to take it further by looking at cost of redeemable debt. I will not do that today. I need to go now. I'll not do that today. We are supposed to look at cost of preference share and so on and so forth. Various forms of capital, we look at their costs, how to compute them, how to get. I'm going to call it a day. Hope to meet on Sunday. We're going to meet on Sunday evening, God's willing. Yes, I think Sunday evening, 7 should be fine. For those of you that will attend your village meeting, should be back home by then. So thank you very much. I'll forward the recordings to the platform as soon as it drops and the slide to the platform. Keep please, I need that assignment tomorrow. Yes, because to me, May is here. If you
I'm
keep
supposed to take on assignment.
Sir, good evening.
Madam, you call the league, do call.
I'm fine, sir.